But let's turn our attention to Z Entertainment. The stock had opened up mildly in the green this after they have initiated some cost rationalization measures. The company's MD and CEO, Mr. Punit Goenka, announced a decision to take a 20% voluntary reduction in his pay. To discuss this, well, we have Karan of Elara Securities who joins us, and the former ED of SEBI, Mr. Gupta, who joins us on the show. Good morning, gentlemen, and thanks so much for joining in. Well, Karan, let's get first, how do you approach the stock? You know, these measures were something that the management has been hinting about, but what's your view on the stock?
Hi, Nigel. Good morning. So I think these measures are very much in line. So if you remember the last quarter and after the deal fell through, the management did highlight that they want to really drive profitability. There is an intention here, to drive EBITDA margins towards a guidance of about 18-20%. Currently, on a 9-month basis of FY24, the margins are very subdued at about 11%. So it's a long haul. A lot of effort will be needed in terms of execution, in terms of how these things pan out. But clearly, the intent is there, to improve profitability. And the stock could see the rating only based on execution and numbers and the financial performance. But of course, in terms of share price, one can't forget the fact that there's a lot of legal overhang on this company, and that will, kind of limit the upside from here on as well, because there are pending cases going on with NCLT. There are some issues going on with Disney as well, to that sports dishonoring of the contract. There could be some creditor issues as well, with NCLT, with the pending cases that were there. So multiple legal overhangs which are there, and that could probably limit the upside. But if the execution on numbers is right and if the performance is consistent, you could see some re-rating in terms of the upgrades.
Okay, you spoke about growth, right? The potential of growth, Karan, but what do you think the growth could be in FY25, considering that, of course, there is this large overhang? So I'm sure it's going to have some impact on their business. And the other thing is streaming competition has intensified so much in the last 1 year, right? Do you think that could be a hindrance to growth for them?
So from a revenue growth standpoint, actually, there's not much here because the linear TV business is not growing more than about 3 to 4% on a steady state. And if you look at the digital segment, there is ample opportunity to grow at about 25-30%. But unfortunately, the contribution to business in terms of overall contribution of digital is about 10-odd%. So blended basis, they would not foresee growth rates of more than 6-odd%. The delta will come only basis margin improvement, because if you look at their EBITDA margins, historically they were at 24-25% in the pre-COVID times after Z5 losses. And currently they're about 10-odd%. So if you look at the margin perspective and if you see margin growth rate from here on, you will see better growth rate in terms of earnings. It could be 25% or 30% on this kind of a base. Secondly, in terms of competition, and obviously we are seeing consolidation opportunities here. RI Disney coming together potentially, subject to the approvals going ahead. Competition definitely is going to increase from here on as we speak. And specifically on the digital side, Z is more focused on regional, so they do have a cloud there. But I think Hindi GC is a struggle here. They're not present into sports, thankfully, so their margins are somewhere kind of protected as compared to Star and Disney, when margins are very, very low because of losses that they make in sports. So somewhere there is respite in terms of what the portfolio is there right now. What is the kind of trajectory of margin improvement that we can see?
Gentlemen, morning. Karan and Mr. Gupta. Mr. Gupta, the story of Z, Karan was talking about the nuts and bolts, right? The business itself. But here there are other issues, right? There is, of course, the deal which, of course, fell through. There is regulatory angle to it as well. So we don't know the final outcome of what SEBI's investigations are into the alleged siphoning of funds. Z, of course, has maintained that all those transactions have always been genuine. But we don't know. We've not heard the final thing from SEBI. If you can comment on that for investors, those will be very, very critical. And if you have any thoughts on what has been announced yesterday, which is that pay cut. Go on, sir.
Very good morning to all of you. See, as I don't comment on a stock price or what is the future of a stock, I can talk about the governance and everything else. See, today, if you look at G is fighting battles at multiple fronts. Earlier, it was only the issues with SEBI and all other things, and originally it was Invesco versus G. Now it is a case that there are multiple litigation that is going on, a failed merger with Sony, problem with SEBI, then problem with Star, and everything else. So at that time, this is all negative things have accumulated in G stock. And at this juncture, the most important thing is that not only fight the battle, but at least create a perception that you are doing everything good. So while I will not be able to comment what is going to happen in G versus SEBI or G versus Star or G versus Sony, I can say that they are taking a small step to say that, okay, we mean business and we are trying to do everything that is possible to regain our past glory. Whether they are successful or not, that is a time will tell. But as on day, this step of taking 20% cut in the salary is a very small step in creating a perception issue, or rather clearing the issue that yes, we want to move ahead and we are realizing the problems are there and that's all. What is going to happen, none of us will be able to say.
Karan, I want to come back to that point you made, which is very important, right, about the overall business. A, the linear TV business is not growing, barely 3 to 4%, as you pointed out, and they haven't been able to scale up the digital business because of several reasons. What then do you think will happen now that we have a big behemoth, media behemoth forming in the form of Reliance Disney? What is the incremental potential downside that you see to Zee's business now?
I think in terms of downside, there could be a correction in terms of growth rates, right? So these growth rates, what I'm talking about for linear TV, the industry is probably growing at about 4% on the linear TV side, and adding digital is about 6%. So let's say if RL and Disney gain market share in the linear TV side, which is they grow faster versus market, which potentially they can because of the synergies and because of the big cloud that they bring. You could see them gaining market share, and at that case, you could probably see Z underperforming versus market averages, which means the growth rate of 4% becomes 2 to 3% on the linear TV side. On the digital side, there are concerns because clearly, on a distribution standpoint, Jio is going to become very strong here because of RR Disney coming together. They have very strong clout in terms of distribution. And that will limit the scale in terms of Z5. Or even if, let's say, Z5 grows at 25-30% on this kind of a base, the losses may not come down very sharply because these platforms will have to invest into content. And that's what we've said earlier as well, that, once you have a large business, once you have a large digital business commanding more than 40% of market on the OTT side, these smaller players are going to find it tough to raise ARPUs, are going to find it tough to reduce ARPUs. To reduce the losses, rather. So I think these are potential threats that one can see as far as Z is concerned.
Okay, Karan and Mr. Gupta, thank you so much for joining us and appreciate your time here on CNBC TV 18.